Okay, section 2.3 here. We're analyzing transactions for operating a business into debit and credit parts, particularly as it relates to owner's equity. Now, remember in the past, from chapter 1, with owner's equity, we started out with investments in the business and withdrawals from the business of cash. Then we got into revenue or any kind of sales increasing owner's equity and expenses of the business as a cost of operations reduces owner's equity. All right. So that's for starters. Okay. And if you're watching this video remotely, you will need to go into MindTap. Where's MindTap at? Go into MindTap. And I want you to go into lesson 2.3, which I'm going to drag over here in a moment, and do some pre-reading, please. Not a lot. Here we go into MindTap. And I'm going to go back to the beginning of the chapter here. All right, let's go back to the beginning of the chapter. There's a lot of stuff in here. Okay, all right. I want you to read everything that is like from page 1 here. Revenue increases owner's equity. This whole section here. All right. Then on the second page, I want you to read anything above the red part here. Analysis for selling services is, talking about accounts receivable. All right. So read that part. Then I want you to, the first 3 pages, for the third page, I want you to read this section. So everything between the transactions here and the red bar here, I want you to read in between and get a feel for the terminology of the chapter. So please pause the video and complete the reading. Okay? All righty. Now we're back. We've done the reading as prescribed. Name different sources of revenue that an amusement park might have. Okay. Ooh, what's that might? Let's see what that might be. Well, think about this. Well, the obvious would be like a day pass, right? I'm thinking Six Flags, day pass. Correct? And you might have a season pass. Another source of revenue. Usually they don't do individual rides. Use a day pass or a season pass. Again, I'm thinking about Six Flags Fiesta that I was at in 2019. Then you have all the food items in a food court. And at Fiesta, Texas, it was a lot of food. There was all kinds of different food options. Okay. Then you could get a drink wristband. This is what I went for. A drink wristband for the day with unlimited refills. That was awesome, especially since it was hot in San Antonio and it was like 95 degrees. I was refilling a lot, except I was doing like watered down lemonade and Coke, Diet Coke. That's between you and I. Don't tell anybody. Okay. Drink wristband. What other revenue might an amusement park have? Well, they might be selling, merchandise like gifts or clothing with their name on it and all that good stuff. But here's one you didn't think of, because this is my friend Tony did from the West Side, another teacher. He had a rental fee. He rented a cabana for the afternoon for like $150. So was I on the roller coasters? No. I was in the cabana next to the wave pool, sipping on my drinks and getting out of the heat. That was me. It was a wonderful day in San Antonio. All right. What else might an amusement park have? Food items. I'm thinking more like lunch, but you could maybe argue and say, what about like candy? There's lots of candy, lots and lots of candy. All right. Also, plus you might buy, and this in addition to day pass, season pass, sometimes you can buy tokens for like putting in the water soakers, the water cannons. When people come off some of the rides, you can shoot them with the water cannons. Great fun, by the way. What else might you have at where you can buy a token to play like video games? Anyway, that's quite a list of revenue items, all of which might affect owner's equity. How? Increasing owner's equity. Yes. That was quite a story just for talking about different sources of revenue that an amusement park might have. And by the way, this is actually a picture of Lagoon Land in Salt Lake City, which is the first amusement park that I can ever remember going to when I was like 12. True story. Okay. So here we go. We're going to go through some transactions that affect owner's equity. Receive cash from sales. Remember, we're operating a web design service company. So here we go. We walk through our DLE here. Receive cash. So we know whenever we receive cash, we're impacting an asset and we're increasing an asset, right? So cash and sales are affected. Now remember, sales is a subset of owner's equity, just like capital is, or drawing, which is a negative owner's equity account. All right. Cash and sales are affected. So number one, with those 4 questions, which accounts are affected? Cash and sales. How is each account classified? Cash is an asset. Sales is a revenue account that affects owner's equity. Assets are increased, debit side. Owner's equity is increased, credit side. Remember, increase of owner's equity is a credit because it's on the right side of the accounting equation. Cash is debited, $1,100. Sales is credited, $1,100. We're increasing owner's equity by increasing sales. And we'll get more in depth as far as sales and revenue and expenses, and then we roll that up into our equity account. But for now, we're just saying sales is on the equity side. Sold services on account. Well, same thing as cash, right? Except they just promised to pay us later. So we have accounts receivable, an asset, sales, a equity account. Accounts receivable, Main Street Services is an asset. Sales is a revenue account that affects owner's equity. Assets increased, owner's equity increased. So we just have the same thing as we just had before, except rather than cash, they agreed to pay us later in the form of accounts receivable. Accounts receivable is debited, $500. Sales is credited, $500. Paid cash for communications bill for cell phone and internet service. Now we're talking about an expense or a cost of doing business. Communications expense and cash are affected. Cash is an asset. And we're on step 2 here. How is each account classified? Communications expense, an expense account that affects owner's equity. It is going to be on that right side. Cash is decreased. We paid cash, so obviously we're decreasing an asset. Owner's equity is decreased because we're increasing an expense. So that gets a little confusing. We're increasing an expense, all right? But because an expense decreases owner's equity, it's on the debit side because again, increases the owner's equity are on the credit side, right? Because it's on the right side of the accounting equation. So anything that decreases owner's equity is going to be on the debit. It's going to be a debit to that account. Cash is credited, $80. Communications expense is debited, $80. Debits equal credits. Assets equals liabilities plus owner's equity. Always. Receive cash on account. We sold something for sales. Cash and, that's a lie. We already sold something on account. Now we're receiving the cash for it, right? You knew that. Cash and accounts, Main Street Services are affected. We're talking about 2 assets. What happens on the right side of the equation? Liabilities and owner's equity? Nothing. This is what we were practicing in chapter 1, right? Cash and accounts receivable are both assets. Cash is increased. Accounts receivable is decreased. The people that used to owe us money don't owe us as much money anymore because they gave us the green stuff. Cash is debited. Accounts receivable is credited. Receive cash on account for Main Street Services. That was a little late on that animation, wasn't it? Michael Delgado withdrew equity in the form of $350. Michael Delgado drawing and cash are affected. Remember, drawing is a negative equity account. It's money taken out of the business. Cash is an asset. Michael Delgado drawing is an owner's equity account. Again, we want to keep track of, as the owner, we want to keep track of the money we pull out of the business, as if like we're paying our salary or something. Assets are decreased. Owner's equity is decreased. However, withdrawals are increased on the debit side, but again, withdrawals are a negative equity account. It's an equity account in the wrong direction. Cash is credited. Michael Delgado drawing is debited. But two accounts are affected when a business pays cash for a cell phone bill. Pause the video, answer the question. Restart the video, communications expense, and cash. Of course, communications expense will be classified as a decreased owner's equity. But two accounts are affected when a business sells services on account. Pause the video again, answer the question. Restart the video, accounts receivable, and sales. What two accounts are affected when a business receives cash on account? Again, pause. Answer the question, restart. Cash and accounts receivable. Does the drawing account increase on the debit side or the credit side? Whoa. Well, remember the drawing account, ordinarily an equity account, right, is going to be the increase side, is going to be the credit side. However, because the drawing account is a negative, we sometimes use the term contra or opposite. It's a negative equity account. So the increase side of a drawing account would be the debit side, which is going to decrease owner's equity. But it increases drawing, which decreases owner's equity. Kind of go around in a circle almost. All right. Our revenue accounts increase on the debit side or the credit side. Which side of the accounting equation are they on? Well, they're on the owner's equity side. And they increase owner's equity, don't they, when we sell stuff? So stop the video. Debit side or credit side? Credit side, because it increases equity. It's on the right side of the accounting equation. All righty. Let's go take a look at our exercise today, if I may, which may take a moment here. Let's go to, if you're already there already, let's go to Working Papers 2.3. Waiting. Pardon. Here we go. All right. Working Papers 2.3. Pull that up. Let's do the work together over here. So we have our accounts. This is a chart of accounts. There's no numbers. And our transactions. We have 5. So prepare 2 T accounts for each transaction. Each T account, select the account title of one of the accounts affected by the transaction, and the debit or credit amount in each T account to show the transition's effect. Okay. Sold cash on account to Johannes Eriksson. Sold services, I should say, on account to Johannes Eriksson. Okay. Let's start with what's debited, right? We have an asset. They're going to pay us later. That's going to be accounts receivable. Accounts receivable, Johannes Eriksson. How much? 125. What do we have on the credit side? We have some sort of sales of 125. We're increasing equity by increasing sales. Let's try pinning this up here. Okay, on the 13th, received cash from sales. Well, as you can see, that's obviously going to be a debit or increased cash. And we're selling something for cash, increasing equity, 260. Paid cash for telephone bill. What's the debit side going to be? The debit side is going to be utilities expense. We're going to debit that for $54. Decreasing equity. We're paying cash, so we've got cash, $54. 16, receive cash on account from Johannes Eriksson. Okay, receive cash. We're increasing cash, debiting for $125. We're increasing an asset, and we are decreasing another asset called accounts receivable for $125. They no longer owe us the $125 that they bought on account in transaction from March 11th up here. March 19th, paid cash to owner for withdrawal of equity. The owner's pulling money out of the business. It's going to be John Jensen drawing. He's pulling money out. We increase a drawing account on the left side or the debit side. We're also decreasing equity in doing so. And we're pulling out cash out of the business. We're decreasing an asset. Okay. So those are your 5 sample transactions in working papers for which I am not going to save. You'll go on to the on your own section in working papers, 2-3. Go ahead and do the terms review for 2-3. Let's chat about this mastery problem 2-1 just for a moment, if we may. Please get you started. So here's our chart of accounts. There's our transactions. We've got several of them. Okay. Now we got a lot of slots for cash here. Gardens Plus uses listed accounts. The T accounts have been prepared for you. Analyze each transaction into debit and credit parts. Enter them in the proper T accounts. Blah, blah, blah. Enter the date of the transaction for each amount. Hint, you must enter the transactions in the order in which they are listed. No skipping. So here we go. Receive cash from owner as an investment. May 1st, we're receiving $3,825. We're increasing an asset somewhere down here in Sadie Dirks Capital, May 1st, $3,825. We're increasing Sadie Dirks Capital for the investment into the business. We're increasing owner's equity. Did I pin that already? I don't know if I did. Here we go. All right. Paid cash for rent. I kind of squeezed myself over here. Well, whenever we paid cash, we got cash going out. So 2, we're going to say we're decreasing cash for $630, right? Well, what's rent? Well, generally rent is a monthly expense as opposed to like prepaid rent. So that's going to be an expense of the business. That's going to be rent expense on the 2nd for $630. Okay. You're going to complete these several transactions by entering them into these T accounts for the mastery problem. And here's the deal, by the way. If you can complete both the mastery problem and the challenge problem, which I have listed as a practice, if you can complete both of those with a total of 2 resets between the 2 of them, in other words, I'm only resetting your assignments combined twice. If you can get 100% on those 2 assignments, you definitely have mastered chapter 2 and you got 100% on the test. That's what you can do with those 2 assignments. Because that's like the gist of what we did in chapter 2. All right. So again, if you have any questions, reach out either via email or with Google Hangouts. And happy assets equals liabilities plus owner's equity. Bye.